This video is all about how to pay the least amount of tax on your car. There are many different aspects to the taxation of cars. There's the tax, maybe if you've got a company, the tax in your company. There's the personal tax. There's whether you have an electric, whether you have a commercial vehicle, whether you have a normal car, whether you have a second-hand car. The VAT aspects, a whole load of stuff. So that's what we're going to have a look at in this video. If you would like to comment on it, I'd be interested in your views, so please do that at the end. And please like and subscribe to the videos so that you don't miss future editions of this series. When we're looking at the taxation of cars, the first thing to look at is how a car is taxed in a company. And it is very different whether it's an electric car, a normal car, or a commercial vehicle. What you'll find is that very few business owners have a normal car in their companies, and that's because the taxation is very high. So why is it high? Well, it's high because the taxable benefit is based on the list price of the car. So it's the list price. It's not anything to do with what you actually bought it for, whether it's second hand, whether you got a really good deal. It's the list price of the car, and that's multiplied by a percentage, then you're taxed on that. The tax on that tends to be quite high because it's all based on CO2 emissions, and if you want a car with anything like some performance, then you're looking at a very high percentage of the list price that you're taxed on. I mean, if you have a Range Rover or something that's fuel guzzling, then very often it's 36% of the list price you're taxed on every year, and that's so high that as a business owner you're unlikely to want to do that. So that's how a normal car is taxed. An electric car is taxed less. So at the moment the percentage of the list price is 16%, but that's going down to zero or very low rates over forthcoming years, and those have already been announced in the budget. So it's a high rate in tax year 2019-20, but then after that it's at a much lower rate if it's a pure electric car. You do need to be careful when you buy an electric car though, because they are making differentiations between different types of electric car. The amount of miles it can run on one recharge is a significant factor, whether it's a hybrid or fully plug-in electric. All these things matter, so you do need to look at the precise specification of the car. So electric cars are a better solution than a normal car, and the taxation within the company is less, so you've got sort of a double whammy. So the taxation within the company is less and the taxation on you personally is less. So electric cars, much lower tax than normal cars. The other possibility is a commercial vehicle. So a commercial vehicle is, a van or a truck, but it can be one of these pickup trucks that can put a ton on the back of the pickup truck, and some of the times they have 2 rows of seats. Although there is a small personal benefit of having a commercial vehicle, they are taxed much less than a normal car, and generally, depending on the sums, it's worthwhile having a commercial vehicle in your company. So are there any circumstances where you would have a normal car in your company? Well, there are one or two. So firstly, there's no benefit in kind in having a car in the company if you do no personal miles. So that means you don't keep your car at home, you keep it at work, and you do literally no miles. Doing 1 mile puts you into the benefits, but if you do absolutely no personal miles, then it is worth having a car in the company. The other extreme is if you do very high personal mileage. So if you did 100,000 miles a year, then it would be worth having your car in the company because you'd just use it up. You'd use it up in a year or two, and if you do the numbers on that, then it will be worth having it in the company. So very, very high personal mileage can make it worthwhile because the tax charge is the same if you do 1 mile or if you do 100,000 miles personally in your car. The taxation of cars is different if you're a sole trader or if you're in a partnership. In this case, the benefit in kind is a proportion of the cost of the car. So if you do 2,000 miles privately and 10,000 miles within the business, you'll be taxed on 2/12 of the total cost. And that can be much more beneficial because if you do 1 or 2 or a small number of private miles, then those are only going to be taxed at cost, and that can be an awful lot better than being taxed on a list price. This is particularly relevant if you've got expensive cars. So if you routinely buy a car for £50,000–100,000, then the cost of that car is actually significant, and it can be significant to the profits of the business. And having a tax charge that's based on your private mileage can be very beneficial in those circumstances. For most people, the rule is if you've got an ordinary car, you don't want it in a company. If you've got an electric car, it might well be worth having it in a company. If you've got a commercial vehicle, it might well be worth having it in a company. And having a car in a partnership is generally better than having it in a company. Now, this is a very highly regulated area, so there's a lot of anti-avoidance stuff, so it's very difficult to get around these rules. So what do you do if you don't want to put your normal car in your company? Well, what you do is you own it privately, and then you claim 45 pence per mile for all the business miles that you do, and you claim that to your company. And you can claim up to 10,000 miles at 45 pence per mile, which is enough for most people, because not many people do more than 10,000 miles a year in their car. And the record keeping then is really simple, because you just need to work out how many miles you've done, which will correspond more or less to your diary. You calculate your miles, you put a claim in, and that's tax allowable. And your 45 pence per mile for your mileage is, you can't really have a receipt because there is no receipt for your mileage. It does have to tie into your diary, but it's just what you claim. So you work out your miles, you claim it back from your company. It's a company expense, so it's allowable for tax in the company, and you get the cash out. So, and that's really simple, and it's really normally tax effective, because normally 45 pence a mile pretty much covers the cost of running a car. I think it's reasonably generous. So the question then is, what is allowable as a mile for business use? I think it's well known that home to work travel is never an allowable expense, so it's not allowable for mileage. But if your first trip in the morning is to, for example, a supplier or to a client or a customer or to any other business activity, and then you go to work, all of that trip is allowable for tax. So the first bit going to your supplier or customer, and then the second bit going to work. So it is reasonably generous, because then you've not done the home to work leg as a disallowable cost. Moving on to VAT. If you've got a normal car, basically you can't get the VAT back on the purchase price. With a commercial vehicle, you generally can get the VAT back on the purchase price, because, well, if you think about it, if you're buying a truck for a haulage business, it's fairly obvious you'll be able to get the VAT back on the purchase price. With VAT, that can be quite a big deal, but there's no VAT that you can reclaim on a normal car in normal circumstances, unless you're a car hire company or something. The VAT on mileage, you can claim back the VAT on the fuel for your car, and if you're claiming it on a mileage basis, you can claim back the fuel element of your mileage charge, but the amount is not, it's not like, there's no discretion about this. You take the cc's of your car, and then there's a pence per mile, which is assumed to be fuel, and you can claim back the VAT on that fuel. So that can be helpful. The only other big thing on cars is the capital side of it. So if you've got a commercial vehicle, you can generally claim back capital allowances, maybe full capital allowances in the first year on the purchases of a commercial vehicle. With a car, there are very restricted capital allowances that you're allowed, and with an electric car, they are actually changing it, but you have been able to get full allowances, and now you can get partial allowances, so you need to check that at the time, because we're in a transition period. In many ways the answer is simple: just keep your car out of your company. But if you have any questions, or if you want me to look through your personal circumstances, then please get in touch. And if you've got anything that you'd like to comment on this video, then please put it in the comments section. Thank you for watching.